Hello, today we are looking at 3 monthly dividend payers that can pay your rent. We're going to take a look at each one individually. Very briefly, we're going to look at their historical prices, and then we are going to end each one by looking at the stock valuation model, seeing how well they are currently valued, their intrinsic value, margin of safety, and what our acceptable buy price would be for these 3 companies. So firstly, we're going to start off with the first monthly dividend payer, Realty Income Corporation, currently trading at $60.91. Now, year to date, this stock is down 4.5% and currently offers a yield of just over 5%. Now, if we take a look at the 10-year graph for those people who have been holding this company for 10 years, it is up 40%. However, this does not include dividends. And as you can see, depending when you bought it within the last 10 years, you could be up significantly more than just 40%. Now, we're going to take a look at the valuation for O, and we're going to see how well this is currently valued and if it is or isn't undervalued. Now, one thing I just want to note, and this will only be for O, I'm looking at Graham's valuation. Now, Graham's valuation is one of the 4 models that we use. However, for REITs, we do not use Graham's valuation. Therefore, moving forwards, this will not be applied. I have inputted it just so you can see, for educational purposes, the earnings per share, the growth rate predicted, and the current yield on AAA corporate bonds. The intrinsic value based on Graham's valuation is 39.54. However, as I mentioned, this is purely just to show you what Graham's valuation would be if we were to run it through. However, it's not applicable for REITs, and therefore moving forwards, we will not include that. So the first one we're looking at today is the REIT multiples valuation model. We have 3 companies in the similar industry as O and similar size. We have FRT, Federal Realty Investment Trust, ADC, Agree Realty Corporation, and Kimco Realty Group. From these, we get the P to AFO multiples, we get the average, and then we have the P to AFO of O, current price, and therefore the stock price is $66.26 for the REIT multiples valuation. We then move on to the dividend discount model, and as you can see, the yearly dividends year on year for O, we can see the average growth here of 3%, and what I'm looking to do is to get P, which is the stock price, the DDM model price, based on the value of the next year dividend over the cost of equity less the growth rate. Now, the DDM, we've used a growth rate of 3.5%, so I've gone for slightly above the average growth rate, as I do believe they will start to increase that dividend slightly higher than 3%. So this gives a DDM price of $70.38. Now, the DCF model, the discounted cash flow model, we input the free cash flows year on year for O. We have the growth rate year on year, and the average growth rate is 22%. Forward looking, analyst estimates around 8 to 10%. I've gone for a slightly more conservative growth rate of 7%, which then gives us essentially the future free cash flows and the terminal value. We then, using our discount rate, get the present value of these future free cash flows and terminal value, add them together, add cash and cash equivalents, subtract total debt, and arrive at our equity value. We then divide this by our shares outstanding to get a DCF price of $72.34. Now, we've just run through these models and we have the associated values next to it. Our intrinsic value is essentially the average of these 3, so it gives an intrinsic value of $69.66. Now, depending on what your margin of safety would be, typically I like to look for around 10%. Some investors like to look around 20%, and it will depend on your risk strategy, if you are risk averse or if you are happy to take on more risk. So our margin of safety, if we look at 10%, your buy price would be around $62.69, indicating that the current share price is a buy. For those who are looking at around 20%, your acceptable buy price would be around $55. And we can take a quick look and see that that is right at the bottom of that 52-week range. Now, what we want to do is have a look and see what Wall Street forecasts for the next 12 months. And for O, they have a target of around $69.61, which is essentially in line with our intrinsic value. So that was the first company that we were going to be looking at today. The second one that can pay your rent, a monthly dividend payer, which I also hold in my portfolio, is Stag Industrials, currently trading at $36.06. Year to date, the stock is up 11.5%, offers a yield again just above 4%. And for those who have been holding this company for the last 10 years, you would be looking at share price appreciation excluding dividends of 70%, so slightly higher than O. Again, it does depend on where you have bought across this 10-year period. Now, looking at the valuation of Stag, we can jump straight in. As always, do smash the like button if you're enjoying the content. Smash the subscribe if you want to see this content keep coming. Now, we're starting straight on the REIT multiples valuation model. We have companies very similar to Stag. We have FR First Industrial Realty Trust, EGP, East Group Properties, TRNO, Terreno Realty Corp, and Cold Americold Realty Trust. Input our stock price, input the P to AFFO multiples, and this gives the average multiple at 29.4, and the current P to AFFO multiple of Stag gives a stock price based on the multiples valuation of $57.44. Now, we jump straight into the dividend discount model, and this for me is probably where Stag lacks a little bit. As we can see, the average growth rate over the last 5 years has been below 1%, average of 0.69%. Using the same formula, we are predicting a growth rate of around 1%. I'm expecting it to pick up slightly, however, not that much. You could argue that is more conservative for those that believe they will start to pick it up. So this gives a DDM price of $21.21. Not surprising given how poor the growth rate is. Finally, we move on to the DCF model, the discounted cash flow model. We've inputted the free cash flows and we can see average growth rate of 69%. Again, I've been a bit more conservative in my growth rate, slightly lower than Wall Street estimates, as I like to keep my analysis on the more conservative side. This gives us our free cash flows and our present value of the future free cash flows based on our discount rate. Add the cash and cash equivalents, subtract the total debt, and we arrive at our equity value. We then divide by the shares outstanding, and this gives a DCF price of $40.74. So we've just run through our 3 models. As we are going along, do let me know your thoughts in the comments about these companies. So we have our 3 models. As we can see, they do vary slightly in terms of their price. So this gives us an intrinsic value of $39.80. Now, margin of safety, again, as I mentioned, for those that are looking for around 10%, you'd be looking to buy around $35.82, which is near enough the current share price, so you could argue it's a buy. For those that are looking for a more of a margin of safety, 20% could probably be sufficient, and you'd be looking to buy around $31.84. If we take a quick look at Stag, that is, as we can see, around that 52-week low. Now, one thing to note is Wall Street price forecast for the stock, again, is fairly in line with our intrinsic value. They expect the share price to be around $38.25 within the next 12 months. So again, we can say a bit more comfort in our intrinsic value if we can see that it is around the Wall Street price forecast. Now we move on to the third company that we are looking at today that can pay your rent, AGNC. Now, year to date, the stock is down 6.4%. And one thing I really want to pull out of this with this company is that yield, 14.8%. So it is quite a high starting yield. For those that have had the company and as a shareholder over the last 10 years, it has been a decrease of 61.64%. So quite negative, and as we can see, it has been dropping all the way back from 2013. So this is definitely a more riskier play, so do bear that in mind. We then move on to the AGNC stock valuation model, and we jump straight in. Multiples valuation, 3 companies that are of a similar size in the industry: Analyse Capital Management, Ares Capital, and REIT Capital. Now, this isn't a REIT, and therefore it's a slightly different calculation, but it's still the multiples valuation model. We input the stock prices and EPS of these 3 companies to get the PE multiple. We get our average at 7.19, which we multiply by the earnings per share to get a stock price of $8.77. slightly below the current trading price. We then move on to the dividend discount model, and as we can see here, unfortunately, there have been dividend cuts. However, over the last few years, they have kept the dividend fairly constant. So the average growth rate over this period is -7%, as mentioned, the dividend cut. So forward looking, I've gone for a growth rate which is fairly flat at 0%. This gives a DDM price of $16.96. We then move on to the final model, the discounted cash flow model, where we've inputted the free cash flows, and we can see the growth has been negative. Now, forward-looking, analyst estimates do have very high targets for this company, over 30-40%. I've gone a lot more conservative at 17%, so do bear that in mind when you see these figures. Again, future free cash flows, present value of these based on our discount rate. We sum these together, add the cash and cash equivalents, subtract the total debt, and arrive at our equity value. We then divide by our shares outstanding to get a DCF price of $13.14. So we've run through these three models, and as we can see here, the prices on screen gives an intrinsic value of $12.96. If we just take a look, right up there at that 52-week high for AGNC Investment Corp. Now, for those that are thinking, what is the margin of safety that you would apply? For me personally, for a company that is on the downtrend and it has a very high yield, I would be looking at a much higher margin of safety. However, let's keep it consistent. So for those that are looking at a 10% margin of safety, it would be an acceptable buy at these prices. For those looking at 20%, it would still be an acceptable buy at $10.37. For those looking for a lot higher margin of safety, given the fact that the share price has been on the decline and there is that high starting yield, you'd be looking at around 30%, which would mean you'd be looking for a buy price at around $9. Again, this does depend on the risk profile of the individual investor. Again, finally, the Wall Street price forecast is $10.61, so they do predict some upside to the current share price, however, not that much. As always, do let me know your thoughts in the comments. Smash the like button, smash the subscribe button. Do let me know if you are a shareholder of any of these companies or if you're looking to buy any of these companies. And as always, have a lovely day.